Welcome back to Investing Talk podcast.
Today we're looking at Applied Digital. This is a fascinating story of a strategic pivot in, well, what is probably the highest growth sector of the market.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so the core of the story really seems to be about transformation. What exactly was the big shift for Applied Digital?
It was a fundamental pivot.
Oh.
They completely overhauled their entire infrastructure model. For a while, they were pretty involved in crypto hosting.
Right, which is a tough business. Volatile.
Extremely. And they made a decision to move away from that, to stop being a sort of general landlord for compute and to become, hyper-specialized.
Specialized in what? Exactly.
In designing and building hyperscale data centers. But not just any data centers. These are facilities purpose-built for high-performance computing, HPC, and, of course, AI workloads.
So that's the aha moment. They're not just retrofitting old buildings. They are engineering from the ground up for the future of AI.
Precisely. And the scale they're going after is, frankly, just staggering.
What kind of numbers are we talking about?
They're expanding aggressively. The target is over 600 megawatts of dedicated capacity.
600 megawatts. Just to put that in perspective for everyone, that's an enormous amount of power.
It's enough to power hundreds of thousands of homes. But here, all of that energy is being channeled into running these incredibly power-hungry AI models, 2047.
So they're building the factory floor for the AI revolution.
That's the perfect way to put it. And that brings us to their competitive moat.
Yeah, if anyone can build a data center, what makes their 600 megawatts so much better than the competition?
It really comes down to two things: design efficiency and location.
Okay.
These facilities, a lot of them are in places like the Dakotas, and they are built from scratch to handle what's called high-density compute.
And that means what,
It means they're optimized for things like liquid cooling. The newest AI chips, the GPUs, they run so hot that traditional air conditioning just can't keep up.
So you have to use liquid.
You have to. And they designed their buildings around that challenge from day one. That specialization gives them a huge cost advantage.
How so?
Well, because they build in regions where they can get low cost and often renewable power. And because the buildings themselves are so efficient, they save a fortune on operating costs.
Right. And we can actually see that in their projected PUE, can't we?
We can. For anyone who doesn't know, PUE is power usage effectiveness. It's a standard metric.
A perfect score is 1.0, meaning no wasted energy.
Exactly. And a lot of traditional data centers might run at, say, 1.5 or even higher. Applied Digital is projecting a PUE of 1.18.
Which is pretty much best in class.
It's incredible. That tiny difference translates into millions of dollars in savings for their clients.
And that kind of efficiency, that kind of specialization, it must have gotten some attention.
It absolutely did. And that brings us to maybe the single most important data point that validates their entire business model.
The customer contracts.
Specifically, the massive lease with CoreWeave.
This deal is enormous.
It is the definitive proof that their model works for the biggest players. We're talking about a multi-year commitment estimated to be worth between 11 and $16 billion.
Let's just pause on that number. $16 billion.
Oh, yeah.
That's not a proof of concept anymore. That is a complete validation of their pivot. It basically de-risks a huge part of their construction pipeline.
It's the ultimate vote of confidence. But, to get a deal like that, you have to deliver. And that costs a massive amount of money up front.
Which creates a certain financial tension, right? This is the other side of that explosive growth story.
Exactly. You can really see that tension when you look at their financials. If you just saw their full fiscal year 2025 revenue.
It was about $144 million, only up about 5.5% year over year. Not exactly explosive.
Right. But that yearly number is a lagging indicator. It misses the inflection point.
And when did that happen?
You have to look at the most recent quarterly results. For Q1 of fiscal 2026, revenue just soared to $64.2 million.
Okay, now that's a jump.
It's an 84% jump year over year. And that tells you that new AI-focused facilities are coming online and they're generating serious revenue. The ramp-up is real.
And this is what the analysts are latching onto, isn't it? Their forward-looking estimates are, well, they're extremely bullish.
Very bullish. They're forecasting revenue to more than double in 2026 to around $308 million. That's a 114% jump. and then continue up to over $500 million in 2027.
But all that growth has to be paid for.
And that is the bear argument right there.
Mm.
This expansion is not cheap. You're pouring money into capital expenditures, into CapEx.
Which means the losses on the bottom line look pretty scary.
They do. Net losses increased to over $233 million in 2025. But this is the classic playbook for a high-growth infrastructure company. You bet the farm today to reap the rewards for the next 20 years.
So the path to profitability is all about operational leverage, getting those buildings finished, filled, and running.
That's the whole game. And the projections show that. EPS is forecast to improve significantly from a loss of over $1 a share in 2025 to a much smaller loss of around 39 cents in 2026.
And how are they funding all this?
With a lot of debt. They recently completed a huge senior secured notes offering.
How huge?
$2.35 billion due in 2030.
Wow, that is a staggering amount of debt.
It is, and it just highlights how high stakes this is. This is leveraged growth. It only works if they execute flawlessly, and that demand for AI just keeps growing.
For a lot of investors, that debt load alone is a red flag. It has to contribute to the stock's volatility.
Oh, absolutely.
Yeah.
Which brings us to what the market is doing right now and the risks people need to understand.
The stock has had an incredible run over the past year.
Yeah, returns over 200%, but it has pulled back quite a bit recently.
From a high of over $40 a share, what drove that pullback?
A couple of things. Some of it is just natural profit-taking after such a big run-up, but there are also some fears around a recent S3 filing.
Can you break that down? An S3 can spook people who don't follow the filings closely?
Sure. In this case, it was a filing to register certain warrant shares. And if those warrants get exercised, it increases the total number of shares out there.
Dilution?
The market sees it as potential dilution, which can put selling pressure on the stock.
But for some, that pullback creates an opportunity, right? A potential entry point.
That's how many analysts are framing it.
Yeah.
Especially when you look at the technicals.
What are the charts saying?
Well, despite the dip, the stock is still in a general upward trend. It's holding above its 50-day and 200-day moving averages, which is constructive.
And institutional money. Are they buying this dip?
It seems like it. We've seen evidence of what's called cluster accumulation, where big funds are all buying at once. One institution increased its stake by over 700%.
That's a serious vote of confidence.
It is, and the analyst consensus is strongly bullish. The average price target is around $29, with some high targets reaching up into the low 40s.
So there's a lot of optimism. But we have to talk about the volatility. This is not a stock for the faint of heart.
Not at all. It is a high beta stock. The beta is 7.06.
7? That is incredibly high. Can you explain what that means for an investor?
Sure. The overall market has a beta of 1. A beta of 7 means that if the S&P 500 drops, say, 2% on a bad day.
This stock could theoretically drop 14% or more?
Exactly. It's the definition of high risk, high reward. You have to be prepared for some wild swings.
And that market volatility just amplifies the company's specific risks. What are the big ones to watch?
There are two major ones. The first and most important is execution risk.
They just have to build what they promised on time and on budget.
Flawless execution is mandatory. They're building at warp speed with billions in debt on the line. Any delays could be catastrophic, not just financially, but for their reputation.
Okay, execution risk. What's the second one?
Customer concentration risk.
Ah, the flip side of that massive CoreWeave deal.
Precisely. Having that contract is amazing validation, but relying so heavily on just a few massive clients is also a risk. If anything changes with one of those key partners, it creates a huge hole in their revenue projections overnight.
So understanding those risks, what should we be looking for in the next few months? What are the catalysts?
The biggest near-term focus is the next earnings release. That'll be Q3, expected in February 2026.
What does the street want to see?
They want to see that high double-digit revenue growth continue. But more than that, they'll be looking for signs of improving operational leverage on the bottom line. That report will really set the tone.
And beyond the earnings numbers?
It's all about operational updates, progress on that 600-megawatt build-out. Watch for announcements about new capacity coming online, like the 100-megawatt building at Polaris Forge 1.
Every time a facility gets energized, it de-risks the story a little more.
Exactly. It turns a plan into actual contract-backed revenue.
And then there are the more speculative catalysts, the market chatter.
Right. There's always buzz about potential new hyperscale lease announcements. If they land another customer on the scale of CoreWeave, the stock would react very positively.
And what about M&A? Is there talk of them being an acquisition target?
There is. Given their unique position, some wonder if a much larger player might want to just buy them outright to get that best-in-class AI infrastructure. It's pure speculation, but it adds another layer of potential upside.
Okay, so let's try to sum this all up. Applied Digital looks like a pure play investment on the AI infrastructure build-out.
It's a classic picks and shovels story for the biggest tech trend of our time.
The immediate challenge is navigating that huge debt load and the very real execution risk.
But the reward, if they pull it off, is tapping into multi-year contracted and explosive revenue growth.
So it seems attractive for different kinds of investors. Short-term traders can play the news flow from earnings and new deals.
And long-term investors can aim to capture a leadership position in a brand new critical industry.
Ultimately, the thesis is pretty simple, isn't it?
It is. They're betting that the global demand for high-performance compute is just getting started and will not slow down for the next decade. They have the right product, they've landed the right clients, now it's all about execution.
Thank you for joining us for this analysis. Make sure you subscribe to the podcast to stay ahead of the curve in the markets.